Banking reform debate. Bangladesh's top bankers challenge the status quo. Will these changes transform the industry for the better? Picture this. The country's leading bankers are asking for sweeping changes to how banks are run, and they're not pulling any punches. If you think rules around who can own, lead, or even vote in a bank are set in stone, think again. The Bangladesh Association of Banks, BAB, has just handed the central bank a proposal that could reshape the landscape, drawing praise, criticism, and plenty of questions. Earlier today, September 7, BAB Chairman Abdul Hai Sarkar reached out to Bangladesh Bank with a detailed letter demanding big reforms in the 2025 Bank Company Act amendment draft. At the heart of it, making the banking sector more open and dynamic, but also stirring up controversy, especially about family influence and ownership. Redefining family. Who really counts? Here's one of the biggest flashpoints. BAB wants to narrow the legal definition of family related to bank directorship. Right now, the law counts nearly everyone, spouses, parents, children, siblings, and dependents, as forming a single banking family, tightly restricting control. BAB argues this is out of step with international practice. Take India, where only spouses or members of a Hindu undivided family count. Pakistan and Sri Lanka keep the circle even tighter, mostly including spouses and dependent children. BAB's suggestion? Only spouses and true dependents should be considered as family for bank purposes. This could open the door for more family members to take on directorship roles, raising questions about both fairness and risk. Ownership limits, raising the bar. Currently, Bangladesh law sets a strict ceiling. No individual or institution may hold more than 10% of a bank's shares. BAB wants this limit boosted to 25% or more, insisting larger shareholders have deeper interest and accountability when their own money's at stake. But here's where it gets controversial. The association warns that tough restrictions simply drive people to sidestep the law, buying shares through others. By making the system more transparent and permitting higher stakes, BAB believes oversight would actually get easier, not harder. Voting rights. A fundamental question. At present, voting rights are proportional. Own more shares, have more say. Yet proposed amendments would clamp down, limiting even the biggest investors to only 5% of voting power, no matter how many shares they own. BAB is having none of it. Their counter-argument: why depart from the time-tested one share, one vote approach? Would this undermine shareholder democracy? Who gets a seat at the table? Board rules under the microscope. Directorship is an even hotter topic. As things stand, no bank can have more than 3 members from the same family serving on its board. The draft amendment is even stricter, lowering the cap to 2. And this is the part most people miss. BAB says these limits block passionate, experienced candidates who could actually strengthen governance. So why not relax or eliminate the rule entirely? Of course, critics worry about family dominance and potential for conflict of interest. Independent directors. How much is too much? Bangladesh law requires boards to include between 2 and 3 independent directors, with a possible maximum board size of 20. The proposed reform wants at least half of a newly reduced 15-member board to be made up of independents. BAB disagrees emphatically. They say packing boards with outsiders reduces genuine owner oversight and might turn banks into compliance machines instead of growth-driven businesses. Fewer independents, they argue, lets shareholders' voices be heard while preserving experience. Shareholding in multiple banks? Restriction or opportunity? Right now, a major investor can own shares across several banks. The new proposal would restrict this severely. No one could hold more than 2% in any bank besides their main stake. BAB warns this will choke investment, both local and foreign, making it almost impossible to revive weak banks or boost sector liquidity. Are such limits necessary for reducing risks, or do they simply stifle market activity? Tenure of directorship, finding the sweet spot. Directors may currently serve up to 12 years, with possible reappointment after a 3-year break. The central bank now proposes slashing this to 6 years. BAB says that's too short. 9 years should be the minimum. They argue stability and experience from longer-serving directors promote market confidence and sound strategy, while shorter terms might leave dangerous knowledge gaps. Director defaults. How long should the penalty box last? If a director's loan goes bad, current rules bar their return for a year. The amendment wants to lengthen this ban to 3 years, including defaults involving institutions they're connected to. BAB pushes back, proposing instead a 6-month penalty, fearing longer bans could hinder recovery of experienced leadership. Can directors serve multiple financial companies? Under the law, anyone sitting on a bank's board can't be director at another bank, financial institution, or insurer. The proposed law sticks with this rule. BAB thinks it's too harsh. They support limiting the bar to holding directorships in other banks only, allowing more flexibility and better use of experienced professionals across the financial sector. Have we got the balance right? Now for the big questions. Will relaxing these rules really mean more responsible dynamic banking? Or could it lead to unchecked family dominance and greater risks? Should Bangladesh stick closer to international norms or build a uniquely cautious system of its own? We want to hear your thoughts. Do you believe opening up directorship and shareholding limits will galvanize the industry? Or is there real danger in loosening these controls? Where do you stand on prioritizing shareholder control versus external oversight? Dive into the comments below. Let's get the conversation started.